All right, guys, so we're going to start this unit that is on depreciation and inventory. So the first thing we want to focus on is depreciation. So when you are depreciating something, you're basically spreading the cost of the plant asset over the asset's useful lives. What does that mean? Well, things such as buildings, machinery, delivery trucks, those things that last more than one accounting period, which is usually 1 year, we need to take down the value of them because they do depreciate. Like, think about your computers that you buy. The value of them goes down pretty quickly, actually, nowadays. And like when you buy a car and you drive it off the lot, it depreciates a lot. So, those are things we have to take into account since our assets are what help us determine the worth of our company. And we can't claim that our delivery trucks are worth $36,000 when really in actuality, because they're 10 years old, are actually worth $10,000. So that is what we're getting ready to talk about. So the first thing you need to talk about when you're doing it is you have to understand the difference between a current asset and a plant asset. So a current asset are assets that are consumed and converted to cash during the normal operating cycle of a business. So basically 1 year. So if you think about cash, accounts receivable, merchandise, those kind of items, they can quickly obviously be converted to cash within 1 year because people pay off their debts, we sell our merchandise, that kind of thing. And obviously cash is cash. So plant assets are things like land, buildings, delivery equipment, store equipment, those things that will depreciate over time. Okay? So when you're determining and getting ready to calculate depreciation, there are 4 things that you need to know. You need to know, what did the item cost you? You need to understand its estimated useful life, which is the expected number of years it's going to last us before it wears out, and then our estimated disposal value. So this means, so at the end of that useful life, what is the amount of that plant asset worth? Okay, so we're getting to replace it, and when do we need to replace that? So that estimated disposal value. And then how are we going to depreciate or calculate our depreciation? So there's 3 main depreciations, and kind of 4 because accelerated depreciation can be counted as 2. We're going to focus on the straight line depreciation because that's the easiest and most used, and it's most used, well, because it's easiest. Whereas that focuses on mostly the time that an item exists, the units of production has to do where instead of years and months, we calculate the depreciation on the units of production. So our delivery check, we delivered 100,000 items, so that's the amount it depreciates in, versus 10 years of life. The accelerated means that either we determine that an item depreciates quicker at the beginning of its life or at the end of its life, and so each year the depreciation amount changes. Okay, so let's talk about calculating. Let's say we have a delivery truck. Okay, our truck cost us $16,500. It has an estimated useful life of 5 years, and when at the end of 5 years, it's going to be worth $1,500. Now, how do they determine the useful life and the disposal value? Honestly, it depends on what you've done in the past, and it also depends on what your competitors do and what they base those items off of. Okay, so it's not just we're going to randomly guess. It's an educated estimate that they based on research. So you take the original cost of the vehicle and you subtract the $1,500 from it, and that gives us $15,000 to be depreciated over those 5 years. Okay. The next calculation that you see up here is the amount to be depreciated. So this is where we're going to actually find the annual depreciation expense. So we already know that $15,000 is what we're going to depreciate. So we're going to divide that by the useful years, which is 5, so that each year we're going to depreciate $3,000. Now this means a full year. And we don't always buy our items on January 1st. So we have to think about how we're going to calculate a partial year, and that's what this bottom equation does. So let's say we own this truck for the first year for 9 months only. Okay, so we bought it the beginning of March. Okay, So what you're going to do is you're going to take that $3,000, that annual depreciation you found, you're going to multiply that by the number of months you've owned it divided by 12, because there's 12 months in a year, giving us a partial depreciation value of $2,250. All right. We also like to know, what's the rate of depreciation on an item? Does it depreciate 10%, 20%, 30%, 15%? We find this by we take our annual depreciation amount of our truck, which was $3,000 that we determined, and we divide it by the amount to be depreciated, which was $15,000. So each year we depreciate up to 20% on our trucks. Let me know if you have any questions.